welcome to the next edition of our Viridios AI fireside chat. Today we're joined by Erica Vertefeuille and Stephen Gill. I hope I pronounced that correctly, Erica. Correct me if I'm wrong, please. The other thing, just to give you quick notes for participants, is that there's a question that you can punch your questions into at any time during the chat function there as well. So help yourself to that one, and we will try and manage to cover your questions as we proceed through our chinwag. So welcome to both of you. I'm the head of partnerships at Viridios AI, so we're just going to delve into the new business that you've put together, which sounds fantastic and innovative. We're always constantly evolving in the carbon markets. But to start, it'd be great to just hear your origin stories, both of you, how you've come to carbon markets, how we're sitting here today, to just give us a frame of your personal passion and where we've come to. So who would like to go first?
I can start. First off, thank you so much, Andrew and the Viridios AI team, for having us. I'll get to it, but you guys have been part of sort of that origin story into how we got involved in capital markets. So it's great to be here. As per sort of what led me here, I actually come after sort of been in finance for some time, but before that I was a geological engineering student, and so always sort of having an interest in earth systems, high impact projects with diverse stakeholders, whether that's financial stakeholders, community stakeholders, or of course the environment that project's in. I actually had an opportunity as a university student to participate in a student expedition to Antarctica. And so climate change and the impacts of climate change sort of always near and dear to my heart. I quickly figured out, though, it was more of a liability than an asset in the field, and was probably better off taking my skills to finance. And after a short stint in investment banking, had the opportunity to join a family office called Pala Investments in Switzerland, where I've worked with Stephen for the last 10 years. I'll let Stephen get into it more deeply, but in essence, under Stephen's leadership at Pala, very much looking into how to use our capital, which is sort of long duration, a little bit more creative in nature, given it is family office, how we can play a role in scaling sort of early supply chains or commodity markets that are linked more broadly to decarbonization. So looking at those hockey stick inflection points, whether it's electromobility, renewable power, semiconductors, et cetera. There's many markets where we've been able to look at the supply chains behind those demand inflection points and assess where our capital can play a role. Carbon markets, started looking at it about 6 years ago, starting where most funds start in compliance markets, and then moving slowly to voluntary carbon markets and Article 6 markets. They're sort of built out our education from the grassroots up, sort of early market education, leveraging sort of our broader network, building a new network, and using a lot of tools in the space, Viridios AI being one of them. It wasn't the easiest market, I have to say. Obviously, we all know sort of the issues around opacity and smaller actors, and it's really hard to get a transparent look into the market. But it's been quite an adventure, and here we are, having launched Terra Natural Capital back in January. It's a partnership between Bain Capital Partnership Strategies out of Boston and Pala Investments, and basically it's a investment platform to scale capital into these projects. Stephen, over to you.
Hi. My background, so I was actually a marine biologist by education, so spent 10, 15 years studied on the research side and regulation in the UK and the US. It always, it's a surprising and disappointing, unfortunately, that what we were doing, I mean, this was just the 90s, but what we was working on in the 90s was already old news, and we still talk about exactly the same topics today in terms of climate and climate-related impacts and the systems to try and mitigate for that. So, I spent a long time all the way back, focused on that area. Worked in environmental consulting with an engineering consulting firm in the UK. Saw a whole range of industrial projects from an environmental angle, both in terms of impacts that they've had on the negative side, and also planning and implementation of projects across the world. And then following an MBA, went to the investment side, to really get that exposure to take something from all the way through the kind of project life cycle, investment life cycle, not just the little snapshots you get from consulting. So that led me to Parla. So the family office that Erica talked about. Really in my 16 odd years there, I've focused on looking at the world through a decarbonisation lens and trying to guide our investments thematically with that worldview. It sounds a bit like a bumper sticker these days to talk about decarbonisation and the impacts on markets, as it's really become front of mind. But you go back to 15 years ago, and it wasn't quite such an easy line to draw. That journey's taken us through a number of different raw materials or supply chain led markets, where you've seen, as Erica referred to, this new type of demand, or this different demand impulse that's taken either poorly formed markets or markets that are small little demand use, and taking them to a whole different scale. And what we've seen time and again is where you don't have in a commodity or commodity-like product, where you don't have a exchange traded, hedgeable, index priced material that's nice and convenient for lenders and insurers to read off a screen and then to allocate their risk away. It becomes very difficult to obtain financing for companies that in those types of markets, and it becomes hard for the markets to scale. And again, we've seen time and again, as an investor, there's an opportunity set to play a role for that period of time as a market matures, to help it get from stage A to stage B, and then the larger traditional project finance, infrastructure finance type groups come in. And so as we'll get into today, there's a lot of hallmarks that we see in the carbon markets today, as a number of those other inputs that have got into different parts of decarbonisation and energy transition. So.
Right, cool. Thanks very much for giving us your background and how you've come to where we are at today. And I suppose it sort of culminates in what you've developed with Terra Natural Capital and that partnership with Bain that you referred to a little bit earlier, Erica. So maybe we can just sort of shift gears now, and with that sort of foundational conversation about where you've both come from and how you look at the market and have come to this point. What did you find? So maybe you can give us a bit of a background as to Terra Natural Capital, how you got to this point, partnering with Bain, and what is the challenge that you recognise that needs a solution, which is your uniqueness, I suppose, in the market with Terra. I think you're on.
In terms of Terra itself, we've been building a portfolio of investments in nature-based removal project, nature-based carbon removal projects over the last couple of years. We formalised that at the beginning of this year in the joint venture with Bain Capital Partnership Strategies. So the mandate for Terra, beyond our existing portfolio, is really to provide financing to sort of bridge that gap between the corporate need and the developer's need. And so to explain what we mean by that, I'll come back to what I said a minute ago. If you're going to scale a market, you need credit or third-party capital, and you need a risk tool, which is insurance, which is nascent in the industry today, and credit again. So those two bits, and we think are key. And so we look at what's happening today, and you see reason to bring a modified version of traditional project finance and trade finance tools. They don't work as they currently exist in energy or broader commodity markets, but they can be modified to apply. And we want to use that to solve two pain points. From a developer point of view, if you want to build a carbon project today, you've got three really pretty crappy choices to finance your project. You can go and get DFI, so you can spend. That's not accessible to everybody. If you're lucky enough that it's accessible to you, you can spend a couple of years with, IFC, AB, BII, these great institutions that are doing something really important, but it's a long road. So that's option one. Option two, you can look for prepayment from a corporate. We've got a handful of somewhat unicorn corporates that are forward-thinking enough and brave enough to actually finance carbon projects direct. But if you're going that route, you're essentially going to try and, again, if you're lucky enough to access the Microsofts of the world, you can negotiate to sell all your credits forever at essentially a fixed price, and you're probably going to end up with 5-10% margin, just enough to keep the project alive. And you're compensating with a low price the risk that the corporate's perceiving to take on. That doesn't allow you to, as a developer, to build equity value in your business, to scale your business, and so you can't scale the market. So that's option two. Option three, you could go to a trader, and again, a handful of really good traders doing good work in the space. Is essentially a variant on option two. So you're going to sell everything forward, fixed price, maybe a bit more flexibility, but the trader will warehouse the risk and then sell it onto the corporate. And so none of those three options are going to help us scale a carbon market to anywhere near where we need to get to. And on the other side of the equation, the corporate sitting there also has three terrible choices. So your corporate, you want to offset, you want to do it in a way that's not going to get you trashed in the media, and ideally meets your kind of broader objectives for actually having some genuine climate action. So you can pay a massive premium on very small volume for some curated retail supply from a handful of retailers that can help develop your net zero plan and source credits for you. Not enough volume to do what everyone needs. You can go and you can interact with the wholesale market. You've got no visibility on quality, or limited visibility on quality. Your blowback risk has gone way up, and you've not got that much control on what you're buying forward. So that's option two. Then option three, you go the route of direct investment. And again, for those that have crossed that bridge, great. But as the CSO of the vast majority of corporations in the world, the idea that you're going to go into the CFO, you've designed a net zero plan. You've gone and got your standards and you've aligned to your standard. You've gone to your whole operation division. You've had them abate the business as far as they can and lose bottom line. Now you've got to go to the CFO and say, right, I need $50 million for this project in 20 time zones away. It's not in our core business or anything close to it. And we might get some credits in 7 years, and we might need them then, and we might get blowback then. It's a terrible equation. And so as a corporate's point of view, we want to enable them to focus on procurement, not investment. And from the developer's point of view, we want to provide just balance sheet financing without taking all the credits. We'll leave the agency there. So anyway, those are the two pain points that we think are limiting people taking their businesses forward, and then more importantly, limiting what we all want to achieve with a carbon market overall.
Okay. Just a reminder, thanks, Stephen. Just a reminder to everyone too, the questions are open too. So please, as you're hearing Erica and Stephen go through explaining what Terra's contribution is and their unique contribution, please just add any questions you've got into the chat, and we can address those as we go along as well, because there's a lot in here to unpack. So it sounds like too that, I mean, correct me if I'm wrong, Erica, and what Stephen was saying too, is this is kind of, we're getting to that maturation of we talked earlier about a bespoke or a sort of artisanal market or boutique kind of market to allow it to scale. we need to sort of evolve from what Stephen talked about there with, the three ways that corporates can actually sort of, step forward, and the problem also for project developers and how they connect the two. So it's that sort of that connectivity in between and how you address that. That's the innovative stage, which kind of like, it feels like, and there's been obviously a lot of challenges in VCM, but it feels like these kind of contributions that you're making, and we mentioned insurance a little bit earlier on too, and that's a whole other kind of conversation. But what you're doing, what insurance is doing, feels like we're getting to a real sort of step change in the maturation of the market too, from that kind of boutique kind of nature to mainstream. And maybe you can talk a little bit about how Terra contributes to that.
Yeah. So exactly. And I think Stephen and I, sort of having built our career around being part of the evolution of a lot of these early markets. I mean, we've seen it before. I think there's a lot of sort of debate in the carbon market today. It all feels hard. It all feels new. It all feels challenging. There are many sort of other markets that have gone through the same. So it was in 2015 and 2016 that Pala, as an example, financed the first greenfield lithium operation in Australia. And lithium was like a brand new commodity. Like there was no use of lithium before lithium-ion batteries. And at the time, to be honest, it felt terrifying, right? There was this inflection point of like EV adoption that, yes, you could believe, but there was a big when, right? And yeah, there was kind of talk that Americans would never drive EVs. Part of it might still be true, but I mean, you look around in Europe, even in the Middle East, in Asia, and there's EVs or Teslas at every corner, right? Similarly, the processing technology, the mining, the off-taker at that time, back in 2015, looking at this very specific example of our project finance, was very, very challenging to underwrite. We did it. The mine came into production. The offtake was filled. We exited our investment, and if you look at the market today, and certainly over the last few years, lithium operations in the Western world are financed with eyes closed, essentially, right? Traditional project finance will do it. Infrastructure funds will do it. Pension funds will do it, right? And that's certainly where we hope to see the carbon market evolve to likewise over the next 3 to 5 years, right? And I think that's all part of that, as you say, transitioning from this sort of small niche early days market to becoming something that feels like a household name, right? And I think the carbon markets have a lot of analogies to work with, whether it was the original CDM, whether it was compliance markets that use project-based mechanisms, the ACU market, the LCFS market, et cetera. There's a lot of experience analogies we can draw from. There's also a very strong demand signal, and I think that's going to help accelerate things even faster. In terms of how where we're playing specifically a role here, and Stephen spoke to these pain points, I think a very quick observation from us was that if you look at how finance is being channeled into the projects today, whether that be direct from corporates, from traders, or from the funds like Climate Asset Management, Mirova, they're all doing great work. But they're LP-based, of course, corporates. They're paying in kind to those corporates. Now, all those three major groups have one thing in common. They all need to finance through the underlying credits, right? And so that, again, as Stephen said, puts the developer in a very hard situation. It also brings corporates who might want to secure procurement, but not exactly ready to put that capital at risk, also in a challenging position. The moment and to be honest, coming in from a commodity world, that's the first thing we thought about. We thought about streaming deals. We thought about off takes, because that's the world that's, to be honest, the world we came from. And once we had the idea to sort of let go of the credit and see what would happen, a lot of really powerful things started happening. And one of those is, in the market today, the best sort of marketer of the credits, or the best person to convince a corporate, please use my credits, right? Please retire them, is actually the developer themselves. And giving back that power to the developer, right, over time, is really how you maximize the value and the impact of the underlying project. Buyers today want the story, and the story comes from the developer itself, right? So this hands-off idea really has been started a lot of great conversations in the market, partnering with developers, not only on the project side, but also the marketing side, and also bringing in the engagement of a corporate, right, early on in the discussions, not as a financier, but simply as an off-taker, pay on delivery off-taker, has been really quite exciting.
Okay, no, that's super cool. I mean, we're at COP this year, and there was, you could feel the pain for a lot of project developers, right? I mean, really struggling to get capital in to be able to scale their projects or even commence their projects, particularly high impact things like, you know, mangroves, and that require a lot of upfront financing. So maybe now, I don't know if you've got like if you can give an example of a project, because I'm sure we've got lots of project developers who are listening here. We've got intermediaries and we've got corporates, but I think the major pain point that we probably took away from COP was that project development. And we see this, I mean, as Viridios AI, we speak to a lot of project developers, and they particularly want to get connected and understand value, and also get connected with where they can sell their credits or get pre-financing and stuff. So that's why I think, you know, we thought it was super exciting to have a conversation with you guys and what you're actually doing in this ecosystem, filling that gap in between the two. So maybe you could just talk a little bit about how a project developer, like what your specific, you know, solution to a project developer for those that are listening, how they can go about speaking to you, connecting, you know, what they need to get in place, and what the kind of process looks like, if you will, so we can get sort of in the weeds of the practicality of what Terra does.
I think when you think about our structure, what's the key risk that we're underwriting? Assuming there's a corporate there that is a willing off-taker at a certain price level for the credits. The key risk we're taking is implementation. Sorry.
No, just one thing, but because I suppose the other thing too is, like we've talked earlier too about the corporates, what kind of corporates, I think, as well. I mean, that will also help, I think, the project developers to what market segmentation they're looking at, because I think we've talked about earlier, like high credit worthy, low credit risk counterparties that kind of are anchor points for that kind of offer.
Exactly. Yeah. So to be honest, most conversations we come into, the developer has already engaged with certain corporates around their project, right? And so these corporates tend to be large Fortune 500 companies, right? A lot of them are tech companies out of the US, just by nature of their offsetting strategies. A lot of these corporates have done the thinking about what type of credits they would like to use as part of their net zero pathway. And again, they've engaged with the developer specifically on the basis of they want to secure a long-term supply from this project. There are also instances where the corporates have been involved in the project design, right? What are the dollars that need to flow back to the community, right? What's the staging? What's the scaling of the project? Those are typically our sort of, when you think about our tier one pipeline or tier one investments, that's the situation we're coming into. That's important for us because we know the corporate has had the buy-in into the project, right? An element of price discovery has happened. That's very important for us and our backers to know that for at least some of the capital, we've done that price discovery work in a world where different projects all have different price points. That's really, really important to us. On the developer side, right? Again, if the corporate is absorbing some of that market risk, we're then taking on carbon risk and implementation risk, right? And that's where we look at the profile of the developer. Most of the developers we're in a discussion with are multi-project developers, in that there's this kind of very typical barbell business model in the industry, right? You have sort of companies with sort of strong retail capabilities on one hand, right? They go out to the corporates, they may advise on net zero pathways and the use of carbon credits, right? Adherence to different standards and pledges and whatnot. And then on the left-hand side, on the other side of the barbell, there's project incubation, right? And project development, et cetera. And typically it's sort of the right hand has been historically feeding the left hand. That's a situation where we can come into very easily to sort of fill out that barbell. What that allows to the developer is obviously to reach out to a broader a broader corporate base, right? A broader client base, and it allows the corporates to expand their access to or expand their procurement strategy because they're no longer putting that capital at risk. On that developer side, then for us, we have seen that they have sort of developed projects. There's many case studies we can kind of rely on that they've done this before. I think there's yeah, I mean, a lot of these are large, especially nature-based removals. They're long duration projects. They're complicated, right? Trees grow in different places in different environments in a very different way. And they're large impact projects, right? They span 10,000 hectares. Do we have comfort that the developer can manage a project over 10,000 hectares? What does their track record look like? So that's often sort of as we go through our DD checklist or what we look for in a transaction, all the key features that we would run through.
Okay, so I'd imagine that data is a huge component to that as well, making sure that you've got like satellite data available and as much as possible that's defendable by the project developer. And we've seen that numerous times too with the more successful project developers. And they also command a premium from that as well by having the very transparent data, very robust and defendable baselines. And then when satellite technology can come in and make those assessments as well, especially for those large kind of nature-based removal projects, which you're referring to there as well. Like in preparation for our conversation too, you've used the term a few times about agency. Maybe we can dig in a little bit into that terminology when you talked about project developer agency and maintaining that agency. It's quite a cool concept.
Yeah, I mean, quite simply, like in, I think, any other sort of more mature industry, this idea that the producer controls its route to market and over time is really important. I mean, you don't see Tesla building the lithium mine and I don't know, Ford running an aluminum plant, right? This idea that we have to break through this traditional model of just developer being in direct service of one corporate or one trader because they had financed the project as really important. This idea that they maintain control of their volumes over time. There are, especially in when we're seeing sort of convergence of different markets, whether it be voluntary into Article 6.4 or sort of regional compliance markets into Singapore as an example, 6.2 bilateral agreements. We expect this convergence between voluntary and compliance to continue. And that's going to be directed, that should be directed in terms of amending the project to those markets and supplying those markets. Those discussions should be led by the developer. And so there's a lot of power, there's a lot of value, and there's a lot of de-risking incorporated into this idea that that developer should retain agency over their credits. There's ways to structure that give us protections that the developer's doing it in the most sort of value accretive but also responsible way. And we've seen a lot of at its most basic level, this idea, what it does is it maximizes the value per ton of that unit, right? Again, this idea that the developer owns the story, right? They also own all the discussions with the stakeholders on the ground. That all ultimately in this market where we're really, really focused on things like integrity, things of responsible production. That's not only now when the project's being designed and implemented, right? That's on an ongoing basis, whether that's monitoring over time, expanding the project, et cetera. It kind of this idea of them having really ownership of that credit that lives on, right? So we feel that's super important that they're part of the marketing of the units.
Okay.
It's an example of the.
Oh, sorry, Steve.
No, it's worth giving an example of the type of value in value in use we've seen when you when you allow a developer to have the discussion with the market without asking for money. So we've worked with developers who, as Erica said, have already engaged with an off-taker, come to a landing on price where the off-taker is going to take all the prepayment risk, off-taker as in a corporate, and then they've engaged with us and they've been able to go back to the corporate and say, actually, don't need the money. We just want to know that you're there to procure, to purchase these credits when we deliver. You're taking no delivery risk. and they've seen, we're talking 4 times increases in. Now that's just one example. Some are higher, some are lower, but you've seen, a quadrupling in the price that a corporate would be willing to pay, and still have inflation escalators when they're procuring, rather than putting all the capital at risk on day one. There's a huge amount of value in what you can unlock for a developer when you're allowed, enabled to go and do price discovery with some negotiating power, versus asking for price at the same time as saying, I need, give me all the money to do this project. So
okay, so the project developer, if I'm to paraphrase, just like correct me if I'm wrong, the project developer maintains kind of like a floating price capability over time, as opposed to taking, quite often we see situations where a project developer has to take a third of today's price as an upfront payment because they're desperate to scale, right? So it's kind of like being in a startup and having to, buy more runway and runway and runway and runway. So yeah, it sounds like that solution you're bringing allows the project developer to access floating price. But it seems like, though, and correct me if I'm wrong, and I'm just a thought that I had then, is that does that lead to more consolidation along project developer lines? So you talked a little bit about earlier on the track record of the project developer, the multi-stake of the project developer, preferably sort of multi-jurisdictional activities, so they're not sort of all exposed to maybe something like, a Southern African state, I won't name, or something like that, where there's potential for nationalisation or all kinds of things like that. So does that mean that we get, maybe looking forward, and just as a sort of a hypothesis, we get consolidation of project developers under the umbrella of big ones? So therefore, smaller ones that have a great project would be better partnering with a bigger proven entity to be able to work with you on financing. And then, so that's part A. Part B is, for a small project developer, are they better to go and sort of come under the umbrella of a big one, or do they need to go, it might be an and conversation, by the way, we need to have more and conversations in voluntary carbon markets, but are they better also to have a look at securing and putting as much effort as possible to securing a Microsoft or a Fortune 100 company as an offtake, even for a small amount, because that's going to give them the credibility to then access capital via Terra in future? So where does a small project developer sit? I'm sure we've got plenty on the call as well, in that kind of ecosystem, and where you're going, where you see the market maturing. Does that make sense?
Yep.
I'm not sure who wants to.
Absolutely. So I think at the end of the day, right, we as the sort of financier of the project need to underwrite the developer's ability to implement the project, right? So I think small project developers, that equals typically smaller projects, not always, but I think it's size to capital at risk, if that makes sense. So there's a really big difference between a $15 million community-based ARR project in Ghana versus a 30,000 hectare owned lands project in Colombia, right? In terms of the skills required, also very different skills, right? From the developer to manage projects at this scale or a much larger scale, right? And capital is sized accordingly. So I don't think the model and track record is simply not just, track record in carbon projects is important, but track record in working at that scale in the country, especially in that global South country, having the relationships with government, et cetera, that can take different forms, right? So not to say that the developers we all work with have done 10 carbon copies of the same project, because that just doesn't exist, because the market is not that old for high impact nature-based removals, as an example, right? And those projects take 7 years. So even if the developer, right, had done 2 previous projects, we're probably not meaningfully into that issuance cycle yet. So I think we take quite a creative way in assessing, do we think developer is do we have trust, right, that they can implement at that scale? Do they have the right partnerships in place? One of the key ways we do that is this idea, and that's where the corporate off-taker plays a couple roles. There is an element of third-party validation and having the off-taker there at the get-go, in that they likewise review the project. They will not bother to go through all this work if they don't believe the project team can implement, right, or can implement. And so that the idea of the corporate off-taker being there is inherently very, very useful as we go through that risk assessment process. We've seen examples of corporate off-takers being there for developers big and small. To be honest, it hasn't been this limiting factor that small project developers have less engagement with corporate off-takers, because it's been so, especially for high impact nature-based removals, it's been tied to the financing process that those discussions would have taken place already. And so we see that very, very, very often in the market.
Okay, cool, super. So I suppose another kind of angle, do you see that as the market matures with your service, and we should probably cover insurance a little bit as well, because that seems to be a sort of that part of that step change. And I imagine that's also integrated and overlaid with the risk profile of the way that you look at deploying capital in this ecosystem as well. So maybe, I don't know, Steve, your turn, something a little bit on the insurance, if that's okay.
Yeah, happy to. I mean, yeah, so within that, exactly where are we today and where would we like to be 5 years or 10 years from now? So insurance specifically, a few people doing good work, Kita, Oka, and others. The broader insurance underwriters have clearly identified the scale of the opportunity set for them. There's white papers out already, have been circulating for a little while. I think the insurance underwriters as a group are eyeing $1 billion or so of insurance premiums that they can be writing in the next 10 years. So the ambition is there, and people like Kita, I think, are sort of leading the charge in terms of developing a product. But that's all nascent. Let's be clear. So I think it's key that you're in the process now of getting to, again, for a corporate to be able, or a financier to be able to take on insurance that will insure you on one hand against non-delivery of a credit, which is key, or other types of insurance from other providers, like Oka, that will insure you against reversal, down the track for that credit. Both have got a lot of, they serve two different functions, but both very key. The first one we focus on a lot in terms of capital at risk, that having some way to sort of underwrite that risk, particularly where you have community-based projects where there's no land asset, that you're reliant on the quality of the developer's implementation plan and alignment to keep that going for the next 30 years. There's no, you don't have the underlying land asset. So insurance products there can really do a lot in terms of perceived risk profile. And then more for a corporate purchaser, when we get to where we need to get to in terms of procurement instead of investment, things like the Oka style reversal insurance, I think, is key in terms of that, removing hurdles to buy from a corporate. And so there's so many hurdles that are put in front of a corporate would be offsetter, that we just need to knock them off one by one. So that's insurance. I think it's growing quickly. It's going to take time to get there. And then even with insurance, the real sort of what we think of traditional project finance, if you think of other industries, I'd like to think it's 5 years away. It's probably 10 years away in terms of SocGen, BNP writing SOFR plus 4%, 10-year project finance money on a non-recourse basis, the way you would think of building a manufacturing facility or a resources project. And then behind that, the infrastructure funds, again, they need to be able to lock in this view of what the price line will be, what's the revenue line going to be. And so where we'd like to think we all get to 10 years from now for the good of like the planet as a whole is, frankly, we should be priced out of the market. And it would be is our ambition that we be, that this model becomes obsolete as the market matures to a point where there's sufficient visibility on price stability and risk allocation with things like insurance and just proof in the pudding of people having been able to look at multiple developers, as you say, that have grown to be creditworthy and multiple projects, that it will get to the point where infra money, insurance money, pension money, bank money can come in, and then there'll be yield compression and the cost of money will get cheaper.
Yeah, like any other maturity sort of trajectory of a market. But I think this market, because of the passion of the people involved, and that's why I want to start with the origin stories, right, as well, is because we've all got passion, otherwise we wouldn't be in it, right, as well. So it's and we're all sort of pushing super hard. So I think we're also open to new ideas far more than more established mature industries where we generally have a bunch of old guys still running it and refusing to change anything. I mean, I worked across a lot of different commodities, and it's a difficult path to convince them to change their mentalities. But it's very innovative by nature. So hopefully the 10 years to talk about there, we can trim that down right down. Like, for example, what happened with COVID, right? It used to be 7 years to take a drug from inception to distribution. In COVID, we got it in what, 18 months? So that's what we need in this market, right? We need all hands on deck to get it there faster. So, but with what you're pioneering here and others, hopefully we can accelerate that maturation and adoption of the across the market. So that'd be great. Now we have other questions coming into. Sorry, continue on that.
I was going to say, you hear the adage I've heard a few times. I think rings really true. It took 150 years to go from coal to oil, and 75 years from wood to coal, 75 years from coal to oil, and then we're trying to rewrite the entire energy system of the global economy in 20 years. It's, as you say, we better get faster, that's for sure.
Yeah, but humans are innovative, so we'll be positive.
Absolutely, no, absolutely.
Okay, cool. We're probably preaching to the choir on this call though as well. So just one more thought on that, just before we sort of go to the question for a second then as well, because I think it's kind of embedded in some of the questions we've got coming in, and then there's a lot of them there. And by the way, the questions, if we don't answer them here, we will endeavour to answer them directly to yourselves. So we'll keep a log of those that are there. If you want to put your names on the call, if they're anonymous, difficult for us to answer, but we'll share them with Terra as well, with Erica and Stephen, and we'll get to your questions. Okay, so we won't be able to get to them all now. But do you think, right, that we get a stratification in the voluntary carbon market? So, for example, on our platform, we have almost 17,000 projects with daily pricing curves across the whole vintages, like 100,000 data points, which obviously you guys use is as one of our customers as well. But it feels like insurance and you're offering these triggers to maturation, that step change, may well result in a tiering of the market. And we already see that too, for example, with high quality project developers that deemed as such, that have high quality off takers, like some of the names you mentioned, the Fortune 100. And then you get copycats. Smaller organizations look to them as leaders, as best practice, and then they follow them into those specific projects. So do you think we kind of get a tiering a further tiering of project pricing and quality, almost as a derivative of your activities and others that follow you after you've pioneered the space, insurance, etc., giving an economic vote to the quality of a certain project and/or project developer? Sorry, if we can hit that one quickly, because I'm going to have to get through a few of these.
Yeah, I would say we already see a tiering in the market.
Yep.
There is, like, I always say that there is this big misconception that the voluntary carbon market is oversupplied. Because certainly for new projects, I would argue that it's undersupplied. And that's why you have corporates at discussion, at project implementation, right? Because if it weren't undersupplied, they would access the units elsewhere, right? And I strongly believe there is this sort of bifurcation in the market. You see it in typically the projects sort of having these new projects that are having these discussions with corporate off takers. They are your high impact high impact projects. Okay, they tend to be longer duration. There is a mix of avoidance or removal. I don't want to get into that debate, but there is a preference, and we see it of new projects where the corporate is engaged in that in project design. Right, we always say we're trying to finance demand versus finance supply. That's also why we see much more capital flows primary than in the secondary market today. That's another expression of that, right? And so when you talk about the size of the voluntary carbon market, and obviously the metric is often sort of secondary market flows. We don't see that in the primary market. Right, it's many multiples of capital flows into projects, into new projects, and so I would say there's already that spread. I think it's a long debate on the market needs a solution for all supply ultimately, or decide to just kind of cut half of it away. I don't know, and that's not. I'm not a trader, and I won't comment on at depth in that. But to answer your question, we do see two markets.
Yeah, it makes a lot of sense. And those corporates that are trying to resource up to do, insetting, for example, and direct investment in project developers, that I think they're going to realize after time too, the amount of resources required to do that. So they're better to outsource effectively to the likes of Terra and others that follow your pioneering lead, to effectively outsource that. So you're doing the KYC because you're taking the risk in the interim in between. So it's why it's super exciting what you're doing, and to have this conversation. Now, I'm behind on questions, so I'm just going to hit a couple of the, I suppose, the big ones. And again, keep them coming, and we'll log them, and we'll try and get back to you all on this. If you put your name there, obviously, again, anonymous, we can't really get back to you. So one of the big ones too is like, is there a sector of the market that you specifically look at? I mean, whether it be geography, whether it be, I don't know, your cook stoves, nature-based removals. So is there a sector of the market? And the other question too, sort of another one kind of related, is minimum size. Is it $5 million? Is it $10 million? I think that would be, a lot of the listeners would like to hear those two answers. If that's okay.
I can take the first one. In terms of sort of project types, so that's geography, methodology, etc. I think, again, following this idea of financing demand, there has been this kind of preference in the market for nature-based removals and high impact ones at that. That's where our capital can play quite an important role, in that these projects tend to be much longer in duration, and so in that respect, and higher risk, right? Trees take time to grow, and certainly native species take even longer to grow, and so that tends to be a larger part of our pipeline. That being said, I think avoidance projects feeding into future Article 6, so whether that's 6.2, 6.4, where there is that direct engagement with government, and we can get comfort on an LOA, that's becoming more and more prevalent as well. And you can see that, I think, a year ago, that would have been almost an impossible discussion. But certainly a green shoot for the market is that we're getting more and more developers come to us and say, listen, we're almost there, right? And I think this will give sort of new life and increased flow of capital to avoidance projects, which have sort of struggled over the last 12, 18 months.
Cool.
On the investment sizes, 20 to 100 million is still a wide range, but that's the preferred size, or kind of, so 20 to 100. The median, we often joke that there's some self-solving, particularly on a nature-based removal project, where everyone solves that $30 million is a round number as the ask. And I don't know, we've not worked out, is that because it's what people feel is bearable, or is that, for some other reason? But, we see a lot 30 to 60 million, but 20 to 100. And that, I should say, again, so people have a lot of projects that have smaller need than that, 5 to 10. We look at the relationship with the developer on that side. So, we sort of bundled, $20-30 million across 2 or 3 projects with one developer, and we appreciate that. They're not all at once. That's in a pipeline. This is fun. Maybe link that to one other similar question on, is that debt or is it offtake? It
That was what I was
is.
going to get to next. Yeah, equity as well. Do
Okay.
you take equity? I think we need to clarify that as well.
Yeah, good point. So equity is difficult for us. Not to say that we can't do it alongside the main financing, but straight equity is not, we're not the best placed for that. So what our financing is, we are putting the capital at risk. Again, let's take a nature-based. It can be, obviously there's things like biochar, what have you, applies the same. That capital is committed today. It can be down against milestones as needed. Again, in a nature-based removal, that could be a 5-year period. We only recover our capital and our return as carbon is issued. We don't require the offtake rights to those credits.
That's a critical point.
So so it's not debt. It's not a loan. It doesn't have a fixed repayment schedule. There aren't triggers, and this is where we say modifying what are traditional sources of project finance to be sensitive to the kind of the variability in a nature-based in particular project. It's things grow the way they grow, and there's weather events and there's all sorts. So we only recover capital and make return as a developer and receive revenues from those carbon sales. Again, we for the right developer, we can look at offtake if that's something someone wants, but it's not something we ask for.
Okay. So for those listening too, like there's a lot of project developer questions I think in here as well, is that it's kind of, and correct me if I'm wrong, it's very similar to replicating what we see in other mature markets, the debt financing kind of capability of bringing, which is like infrastructure. In essence, if we sort of like can encapsulate it.
It looks like infrastructure financing, long-term participation in the revenues, and we want the developer to have, back to that agency, we want the developer to get the best possible price for these credits, and because we'll participate in it, and the better they do, the better we do. So
and the better for the communities on the ground too. There are custodians of these assets and stuff as well, and distribution through SDG contributions and stuff as well, which are important. So no,
that'd be a key thing for us is community part. So on a DD side, community participation will be like right at the top of, if we think something looks sustainable as a project. Yeah.
Well, that's another good one for the developers to hear on the call, and for the corporates to know that that's like right at the top of your pops as far as doing the analysis. Awesome. We're coming up pretty close on time to just do sort of some wrapping up, but one more that was here too is we mentioned, with the financing, we've talked about insurance. One question that came up here too was about rating agencies. Do they come also into your analysis? And there's obviously a few of them out there as well. We partner with a number of them. Is that part of your assessments? We talked about data before as well.
Absolutely. I'm not explicitly. It's not like we would say that the developer must seek a rating and it needs a minimum rating, but we do see that corporates are using the same benchmarks for assessing a project that the rating agencies do. And so I would say that's where it starts to play a role. There is in more and more discussions, as we do as the corporate does the assessment on the offtake, as we do the assessment on the investment, there's more and more this idea that Silvera and B0 or another rating agency, Renoster is another one, that they can currently do a review of the project as well. So it's all about that sort of third-party validation. Again, they're leveraging sort of best-in-class technological tools. We want to leverage that as much as possible into our risk analysis.
So triangulate everything you can to minimize your risk.
Yes. Yeah.
I mean, it's very logical,
the only tough part is obviously the highest rated projects often are the riskiest from an implementation standpoint. And so that's what we have to sort of measure up as a market. But no, the right discussions are happening.
Yeah, that's great. I mean, look, we could talk hours. So corresponding adjustments, that as well.
Yes, that we always talk about the unicorn project of community-based native reforestation with a CA.
Oh yeah, yeah.
And
They're
that
like
would be
right
the
up there.
triple, like the dynamic MRV. You can throw it all in there. It starts anyway. Yeah, there's many ways to cut it, but no, they're doing great work, and of course we see it very aligned with how buyers see the market, right?
Yeah. I mean, those kind of top of the pops, like ones you described there as well, they have multi credit sort of issuance. They work with local community, they create a crop that they can sell.
Exactly, biodiversity credits.
I mean, they're awesome, but they tend to be small in scale, just because of integration with the community.
So I think that's the toss up is that, like, yeah, I mean, all the projects we would dream of doing, they tend to be the highest risk, and they tend to be they can only be implemented at small scales, versus obviously there's arguably lower rated projects, but kind of you can do it at mass. So
maybe that's a place we go to, right? And this was talking about that umbrella kind of conversation too. If you can get a number of those different kind of smaller projects effectively coming together, like we'd see in cut my teeth in agriculture trading, right? I mean, we have cooperatives right around the world in different parts of the world. Now, if you imagine, I suppose you had a cooperative sort of situation where you could buy an amalgamated sort of diversified jurisdictional credits effectively from those kind of small projects grouped together under the umbrella of a well-known project developer. That could be quite cool. Anyway, we could talk for ages on that too.
But you're right on it. Like, that portfolio approach is incredibly important. That's how, again, buyers are looking at it. That's how the large developers are looking at it, and that's certainly how a financier has to look at it. We don't have a crystal ball, right? It has to be sort of widespread in terms of where we allocate our capital and how.
Yeah, awesome. Right. So we've got 3 minutes left, and so we're going to have to get to a lot of these questions later, but we'll sort that out. So apologies to everyone if we haven't sort of tacked your direct question. So I'm sure Stephen and Erica are both available, as we are. If you have any follow-up questions, just hit us up directly. You can always get us on LinkedIn. We're quite active there. And I know that Terra Capital is well known. I know that you guys, Terra Natural Capital, are well known. I hear lots of good word of mouth as well. I think if there's just maybe 1 or 2 things, or up to 3, just like real kind of bullet points you'd like to leave to resonate with the audience. I always like to finish a conversation that way too, so it really sticks in people's heads. So we bookended it with your, Antarctica and your history as a microbiologist, Steve. So let's bookend it now with the 3 things you'd like people to take away as well.
So I'm happy to.
You want one each? One each.
Yeah, you go. So we need new types of financing to be able to scale markets. We talked about that a lot. When I take the developer side, Eric, you do the corporate. Developers need access to balance sheet that doesn't require all of the credits, and that's what we're trying to do here. We want to provide capital to developers. We want them to get the best price they can get for their credits and support them in scaling the business. So that's the key on the developer side. And over to you, Erica.
And on the corporate side, I think for the market to scale, we cannot expect them to underwrite development and finance development risk. There will always be sort of a small sliver of corporates that will be able to do that. It's all about using finance to maximize their ability to access these markets, and that's going to be the big sort of snowball effect for demand.
That's awesome. Yeah, you sort of did but to use your analogy, the barbell then. But
Exactly.
you're the bar in the middle of the weight, yeah?
Trying to, yeah.
Nice analogy. All right. So just to wrap it up, we love working with you guys. We always have when you were with Parler and now with Terra Earth, and I think it's great. It's very invigorating also to work with people in the ecosystem who are innovative and thinking about new things and trying to drive collaboration as well. So it's an exciting journey to have been able to join you on in some small way to contribute to that. And we hope it continues for a lot longer, and wish you much success in what you're doing, and hope that your pioneering effort pulls a lot more, in the wake of what you're contributing to the ecosystem. So thank you very much. And again, we'll get back to these questions that everyone's got here as well. Thanks again.